Thank you for joining. I'm Adrian Helfert, the CIO of Alternatives and Multi-Asset here at Westwood. What a first half we have seen. Let's do a quick recap. The S&P 500 index was up a whopping 16.6%. That's very close to the average full-year return that we saw in the S&P 500 for that prior 13 years to 2022. Recall, 2022 was the doldrums, both in equities and fixed income, primarily due to interest rates rising from central bank policy becoming tighter on constraints because inflation was rising. So much of this has been monetary policy and interest rate rising concerns with some geopolitical risk concerns. The question now is, can it continue? We've had a great first half. Is that all that the market has, or could we see a continued appreciation in markets? Let's go back and look at some data. We did an analysis back to 1929 when the first half returns were more than 10%. Then what does the second half look like? Well, that happened 33 times since 1929. 27 of those times, the second half returns were higher than zero. The average was around 8.5%. Means the momentum of first half returns does more often than not lead to an appreciation in the second half as well. That certainly does not mean that it's going to happen this time, but it's at least a historical paradigm we can look to and say, just because first half is great, the second half doesn't have to sell off. We could see more appreciation here. Equity markets have appreciated significantly. Their valuations, I wouldn't say they're stretched, but they're above average. They're above average on a cyclically adjusted metric as well. Long story short, it is possible we're going to see more. We do actually look for more appreciation in the equity markets, but we're not looking for that 16.6%. The key metrics to watch are going to be goods inflation and rising wages, most certainly. We do expect that inflation has peaked for this cycle, but it remains elevated and it's above the central bank's target rate. We will actually shortly have more information coming across throughout the next several months on whether inflation is truly coming down enough to achieve the Fed's target, and whether the Fed is going to be looking and saying they're appreciative of expected inflation, not just contemporaneous inflation. We don't expect we're going to see a stimulative monetary policy environment, but they're not going to drop rates this year. That's not the expectation, unless we see a dramatic downturn in economic growth. More likely, we see lower economic growth for the third quarter and the fourth quarter, potentially negative GDP growth year on year, but more likely than not, just very low and sub 2%, certainly, which is the long-term average. In the sectors, the technology sector has had a blistering run here with wage inflation high and the unemployment rate low. One thing to think about is companies are spending on technology in order to increase their efficiencies, to combat wage inflation, to keep their margins at least stable, if not improving. Profit margins are at high levels right now, and they want to keep their profit margins very strong in order to create good earnings out of the revenues that they're generating. Energy prices are reasonably stable. They're at reasonably elevated prices that are keeping good cash generative flow for those companies involved, for energy companies, by and large. This is an area where we continue to find opportunities to invest as well, and we think that this is helpful from a ability to keep yourself too exposed to higher inflation should it be persistent for longer. Overall, the equity market could appreciate further. We don't expect a significant 16.6% from here, but we do expect that it could be stronger. And certainly one area that we like is value and quality. We think companies that are returning cash to shareholders in the form of share buybacks and dividends will perform better in an improved manner in the second half of the year as rates show that they're going to remain elevated for a longer term. Much is dependent on what we see in the second half inflation data, the wage inflation data, and third quarter and fourth quarter earnings from companies. We'll start to see that more this week with third quarter reporting from the banks kicking off, and we'll have more of that over the subsequent weeks on the third quarter of what companies are telling us about the forward prospective environment and spending and capital expenditure, those things that are good virtuous cycle indicators for continued growth. Corporate bonds are an attractive area to be involved in. The upside versus the downside is improved on corporate bonds in a higher interest rate environment, and yields are very strong for investors. Right now on investment grade corporate bonds, earning a 6% yield can be quite attractive relative to an equity market that is fully priced or fairly priced and maybe has some appreciation but not significant with some downside risk. So for investors that are not ready yet to be involved more in the market, having some corporate bond exposure is an attractive place to be. Overall, we look for inflation to have peaked out and to continue to come down. We'll look much more at what the central bank is telling us about whether they're going to be using rising interest rates to control for inflation further. If so, that could be bad for the markets. We don't expect that they are going to go much further, and that's the indication that they're giving us. Maybe they hike once or twice more, but we're nearly done. We're nearly there. So thank you for listening. The Westwood team is always here for your questions and your insights as well. We look forward to hearing from you.